Hi everyone, so this is a recap for January 2025. My return on capital, the realized return on capital is 4.78%. And basically I had two ZW trades and one ZL position. They were all strangles and I want to go over them and just going to go over my trade selection process. I think also might help. And at the end of the video, obviously I'll go over my strategy briefly. I will make a separate full video for my strategy. And also we will go over I think we only have two trades here. This is my new essentially Futures Options Academy, and if you're interested to join, let me know. But basically this is where I post my trades live and so on and so forth, so you can copy them. And obviously this is where I do a lot of one-on-one work with some other traders. But let's go over this position. So this is the ZL position. So it was open on January 12th. We have the strikes, we have essentially the amount of contracts. So I collected about 6.7% of my total account value in credit with this position. This is how the graph looks, and we'll go over the graph also with like the actual graph on TradingView. But basically the position hit about 43% of credit, and I just closed it a few days ago, mainly because of the tariffs that Trump is imposing on Canada and Mexico. And Canada does export, if I believe correctly, some soybean oil, not a lot, but also some wheat, and which is the next position I want to talk about. It's the second wheat position. But overall, this position was really good. 17 days, 43% of credit, and we opened it with 103 days to expiration. The reason for that is because the range to the stop losses. So the green lines are the range to the stop losses. These are not the strikes. And obviously the range was pretty nice, and the range with about 45 or 60 days to expiration was just not as big. So I ended up not opening the position, and we opened the position right over here, and actually probably easier to see it right here. So we opened it right over here. Actually, it was open on the Sunday. So I guess cannot see it here, but it was on Sunday after 8 p.m. after the grains market is opening. And the reason I opened this position is two things. We had obviously really good range, and I had ended up opening a skewed position. So you can see this is where we opened it, give or take. You can see the price is not, or the stop is not equidistant on both sides. This was on purpose because the range to the stop loss, or the range to the stop losses, is this way is occupying a huge amount of price movement all the way since 2023, October 2023, right? So this is why I decided to go with 103 days to expiration and a skewed position. And if we take a look at the CVOL here, so on the 12th, well 13, it was actually a bit lower. It wasn't this high. It was a bit lower, but this is basically where we opened the position, which was relatively high for the past 3 months and for the past 6 months. And obviously the price went down. Now volatility increased because there were some concerns about the weather in Argentina and Brazil, which are two countries that export soybean oil quite a lot. And these weren't pretty strong news. And also because the CVOL also went up on January 10th because there was the monthly WSDE or WASDE report, which indicated there were not enough soybean or the exports amount for 2024 were much lower than expected, and CVOL just kind of shot up because of it. And in my book, these news are pretty much have nothing to do with what's going to happen forward. It has nothing to do with fundamentally the supply and demand chain. So for me, it was just just fake panic, which is basically what I'm looking for, to sell overpriced options on when the reason is really not fundamental. And obviously, this is exactly what I talk about on the academy here. Now the academy, there's no upfront cost for it, but I'm very specific with the people that I choose to work with because it is pretty labor intensive for myself. And obviously I give a reasoning for every single each and every position, and we have obviously potential positions, and we have some testing that we do, and the economic calendar, which is really important. We can see exactly what what reports we have, and what they can basically affect from my experience, basically. So this was one position. Second position, we opened it up actually not too long ago. It was only 7 days. I only closed it for 5% profit on the credit, and this is again because of Trump's tariffs, which I don't know if he will impose and how much, and if it's going to affect the commodity market at all. I think it might, because Canada exports I think quite a lot of wheat. So I don't know if it's going to affect it or not. But with the market, if there's something I learned over the past 9 years, it's better to be safe than sorry. So I just closed the position and I can reopen it, after the weekend, and we'll see what's going to happen. But always going to be safe than sorry with the market, and we got a bit of profit here. So this position was opened up exactly for all the same reasons as the soybean oil position. You can see a massive range to the stop losses, and again, this was opened with I believe 93 days to expiration. So also quite a bit, but I was really comfortable with the range, and you'll see why I opened it with more days to expiration, because my previous trade on ZW, which was the first trade this month, was way tighter, and it was a roller coaster, and I didn't like the price swings for ZW. So we opened this position on Thursday, which I believe actually was on a Wednesday night, but the way the hours work, so it will be basically Thursday. What is it? January 23rd. So let's take a look and see what was the CVOL at that time. So 3 months, so 23rd was right over here. So pretty high CVOL, not the highest, but pretty high CVOL. Actually, we opened it right over here, so CVOL was actually pretty much the same, but we waited for basically the price, or I waited, I guess, for the price to go, or for the CVOL to go down a little bit after the spike up, and I opened up the position, and as you can see, relatively it's a pretty high CVOL. So it was pretty good. The price, the CVOL went down. It really helped us a lot, but obviously it started going back up because of the fear of the tariffs and their effects. Now, the reason I opened this position, so if we take a look here, is CVOL was obviously relatively high based on relatively to the previous 6 months, and there were some supply concerns due to the weather in Argentina and Brazil for ZW as well. But again, these are small factors, and there's no fundamental issues with the supply and demand chain, basically. And also, there were some rain forecasted in Argentina in the coming weeks. So this is just basically not it's just fake panic, basically, as well. But I had to close the position quite early, just to be safe than sorry. And this is, the reason for early exit is Trump might impose tariffs on Canada and Mexico, which will influence the price of ZW, as Canada exports it as well. And better be safe than sorry in this case, and in probably most cases where things are out of the ordinary. Now, the last position that I opened, or it was actually the first position of the month, it was right here. It's still in the old format. Everything will be obviously on the Academy, but basically I opened it right as the new year obviously hit, and we had 49 days to expiration. It was a good position. I took half a position because the range wasn't as good as I wanted, obviously. So you can see the difference. This is night and day, obviously. All right, it's way tighter, and the position was quite a roller coaster. It worked out pretty well, but still. And what I looked for, obviously, when I opened it, it was the CVOL. So let's go over CVOL here again for wheat, and it was on January 2nd, which CVOL was right over here, which was relatively not the best, actually. If you look at the 3 months, it's kind of okay. It's kind of downtrending, so I was okay maybe taking that trade. When I look at it now, probably should have taken over 100 days to expiration. It would have been much safer. But CVOL went down, helped me quite a lot, and obviously I closed this position really quickly, really quickly. And it worked out pretty well. But CVOL here wasn't as high, but still kind of wanted to open this position. and just open it for myself. It happened to work out. I should have probably opened this position on a demo account, which like I do with some of my other positions, which this is one of them, and also a gold position, which again in the academy, this is where it's under the testing tab. So this is basically it for all the positions. Really nothing too crazy. Just looking for high CVOL for a good range, and if it's as simple as the ZL position or the CW position, the second one, even though we exited early, we had a crazy amount of range. This is quite insane. And obviously the first DW position was not as good, and definitely not something that should be taken, or maybe if you only take it maybe 1/4 of your actual size. I took 1/2 or half of my actual size, and I tried to collect about 3% of credit or 6% of credit per position and profit about 3%, and this one was obviously half of that. Now, my strategy, just to kind of go over it quickly, is basically I pretty much only sell short strangles. I can definitely sell some calls and puts, short calls and puts here and there. Very rare, but it can happen if there's a good opportunity, which there haven't been any for the past month. I tried to stick to 45 days or less, but obviously, if more days to expiration just make more sense to me, based on a graph, based on basically just based on my range to my stop losses, this is what I'm gonna do then. And this is all the products that I basically trade. Short strikes are at delta 20 to 21 usually for strangles, and delta 35 for the short calls and puts. My profit target is 50%, stop loss is 50%, and obviously I move my stop loss as the position is improving. So at about 15% of profit, I usually, it depends, but I might move my stop loss to 35% loss. At 25% profit, I'll move my stop loss to 25% loss, and at 40% profit, I'll move my stop loss to 10% profit, right? And then from there, you're just gonna ride up either to 50 or you're gonna go down to 10, and either way, we will make a little bit of money. And as always, I'm gonna use CVOL, so the commodity volatility index, for a good entry, as you saw with my other three positions. Well, I guess two positions that were really good CVOL, and then the first ZW wasn't as good. Now I will exit if my targets are hit. I can exit 21 days to expiration, just to not get hit with gamma. I can adjust if needed, which should again never happen. I don't ever see a reason to adjust the position. And obviously I can exit early, which I did with the ZW trade this month, because we want to be safe and sorry with the market. We don't chase profits. We do, obviously. I want to profit, but I'm really focused on managing my risk. And for me, it's all about this thing, loss target, and just managing my stop loss as aggressively as I can to and obviously enter the best possible positions that I can, because this will really help me to be able to be aggressive with my stop losses and profit more, obviously. So my win rate is about 93% overall over the past few years. So thank you so much for watching. If you have any questions, let me know. If you want to join the academy, please email me with my email address below, and we can talk and we can see if we are a good fit for each other. And again, thank you so much. Have a good weekend, and I'll get you in the next one.